but that's the rate the banks pay to borrow money off the Bank of England.
And that's what we here call the base rate.
The base rate, exactly.
Absolutely is, because just in this session, I've understood more than I've ever known.
We can't leave pensioners behind. So they want to make sure that your pension rises in line of what's happening around.
The quickest way to get people to do their own research is to actually put a cash value on it.
Welcome to the last episode of Series 1 of the Pension Confident podcast. But no need to worry, because I am really happy to tell you we'll be back with a whole new series in January. I'm Philippa Lamb, and to wrap up this year, we're going to demystify a subject that has confused all of us at one time or another: financial jargon. Whether it's stagflation, inflation, auto-enrolment, or all those acronyms, what do they mean? From interest rates and income tax to dividends and bonds, sometimes it feels like the language of personal finance is specifically designed to confuse us. So today, we're going to push back with jargon-busting help from two expert guests. Vix Leyton is right here with me. By day, she's a personal finance expert. Off duty, she's a stand-up comedian and host of the False Economy podcast. Welcome, Vix.
Oh, thank you so much for having me.
Thanks for being here.
It's rare to have something that so matches both of my interests in one.
Unique, maybe even unique. Also with us, PensionBee's very own Chief Marketing Officer, Jasper Martens. Great to have you with us.
Thank you for being on the podcast.
Before we start, as always, I am going to remind you that anything discussed on this podcast should not be regarded as financial advice. And when investing, your capital is at risk.
I think for most people, it's either the money you earn on your savings. The bank pays you an interest rate because you've given them some money in their bank, and therefore they give you a percentage in return. But it can also cost you. So if you've got a mortgage, an interest rate means that it's the kind of money you pay to borrow money from a bank or another organization. And that interest rate is usually set by a central bank. So they've got a base rate. So
central bank being, in this case, Bank of England.
Bank of England. So, for example, recently the interest rate has been gone up from 2.25% to 3%. But that's the rate the banks pay to borrow money off the Bank of England.
And that's what we here call the base rate.
The base rate, exactly. Then the banks who borrow that money can then borrow that money to you as a consumer. It's basically indexing your pension. What that means is making sure that if we've got inflation or the average wages are increasing or any of those, we can't leave pensioners behind. So they want to make sure that your pension rises in line of what's happening around. So there are 3 locks.
Okay.
Lock 1, rate of inflation. And at the moment, I think it believes is running around 10%. So your state pension could rise to 10%. Or
rise by 10%.
Yeah, or let's say if the increase in average earnings is 8%, or in this case, let's say it's 15%,
okay,
it will actually rise more than the 10% inflation. The third reason it can rise is just 2.5%. It's like a fixed fee. So what it means, if any of those, the highest, that's the one the pension will grow. So annuity is something that is not as popular now as it was. But what it basically means is, let's say you are getting to an age where you want to retire and you have saved a pot of money. You can give that to a pension company or a life insurance company. And in return, they say, oh, thank you, Jasper. Thank you for your pension. For that, I will give you, until you die, a fixed amount every month.
Every month.
Or every year. And an annuity rate, for example, of 5% is basically you get 5% of your pot every year given to you on your bank account until you die. Now, that is usually linked to interest rates. So this is where the base rate comes in.
Right.
So if everything is really low, that annuity rate is not going to be a lot of money.
Absolutely is, because just in this session, I've understood more than I've ever known. And because it is scary, you'll read the first couple of paragraphs, even when you Google for something. And if you don't engage with it straight away, I will just
It's bewildering, isn't it?
I try. I'll sit down and I'll try. But I think people are embarrassed to ask questions. for me, it's important to create relevancy and to try and put a value on it that people will understand, because the quickest way to get people to do their own research is to actually put a cash value on it. Because I'm coming up to 40 and I am a Peter Pan. In my mind, this is something for later. I am astonished that there are 21-year-olds now that didn't exist when I was a teenager. But I think we all want to believe that we're still young enough that we could change the game. So I think it's brilliant that all these resources exist, but particularly now with the cost of living crisis on, where you're trying to work out how you can budget to the end of the month, budgeting for even 10 to 15 years time feels like that is a problem for another day. So I feel like the press and experts need to do more to highlight the difference between tackling it now, like take the hour now, versus leaving it a few years, 5 years, 10 years, 15, because there's a penalty for that.
A couple of handy websites I would check out. Money to the Masses. I really like that website.
Why is it a favourite for you?
Because it's Damien is one of the guys who were behind the website, worked in the financials industry, and actually thought, hey, I need to educate. So they are kind of like explaining it in a really easy way. Boring Money. Really good website too. Yes, exactly.
I mean, they're really underselling this.
But it is.
Apparently not.
How can you turn something boring into something actually really exciting and hopeful? And that's what they do.
Okay.
They've also launched a really good community hub, especially aimed at women and savings, because they tend to be behind in terms of their pension savings, for example, and generally savings for later. So I think that's really good. And of course, Money Helper is definitely a good one to go to.